the list, right? I'm sure there will be a few.
Yeah, sure.
The news flow is positive, but you never know.
Absolutely. Well, let's get in our sort of first guest on the show. Adrian Mowat needs no introduction, market veteran, emerging market equity strategist. Adrian, great to have you with us here. Thank you very much for your time. You know, when data goes one way and price action and markets another, what do you follow? They say price action. Are we at that juncture where you start to? I mean, this is the market pivoting in that sense. What's your sense? Maybe not the Fed, but the market.
Okay, so to try and unwrap what you're asking me there, the job data was better than expected, but I think what the market's been much more focused has been on the inflation data and how that data has been surprising positively. And so when you look forward, remember that we have futures markets for interest rates, and those futures markets were forecasting rates moving above 5%. And so that was already discounted in. And those don't seem to have been impacted by these the stronger than expected job numbers. I think the other thing is that the market knows that job numbers are lagging indicators. You know, employment lags economic growth, lags the slowdown. And I think what the market's also been a bit more encouraged by is that we're getting the sense that the Fed is thinking ahead and remembering that monetary policy has a lagged effect. So we've spent the second and the third quarter of this year with the most extraordinary headwind of inflation being above expectation, a Fed behind the curve, the most rapid increase in interest rates that I've ever experienced in my career. And that was a huge headwind for capital markets. And what capital markets are doing at the moment is they're breathing a sigh of relief. That headwind, which is the rapid rise in interest rates, now seems to have gone. It's not a tailwind. I don't believe in this sort of idea of this pivot that you're going to get a quick cut in interest rates. Typically, interest rates move to a level and will stay there for a period of time. But there's another incredibly important factor going on at the moment, and that's what's happening in China. So China is opening up. It's going to be disorderly. You might see some scenes like we saw in Hong Kong in the first quarter of this year. But again, the market's looking through it and saying, okay, this huge drag on the global economy, China's lockdowns, China's disruption to consumption, to consumer confidence, we could see a situation that as we leave 2023, that is behind us. And so we're seeing markets respond to that. Now, Chinese equities have rallied a lot, but we haven't even got to where we were in the middle of September. So I think we also need to think about putting that into context.
Adrian, good morning, and it's good to see you after a while. What about a market like India? Because we've been hitting record highs. Of course, there's a bit of a pause at the moment, but the momentum is so strong, and now is when there's a lot of money coming into the broader markets as well. Would you continue to pump money into a market like India? Do you think that this is just the start of the second leg of the bull run?
Okay, so I think the environment for equity markets is much better than it has been, and India will benefit from that. I think India is a place that will see quite a lot of asset allocation away from India as we go into year end. India has been a very significant outperformer year to date. If you look at EM funds, they're significantly underweight China. We're beginning to see the big investment banks upgrade their China exposure. You know, the real outperformance of EM in November has basically been driven by Chinese equity markets. And so I think international portfolio investors are going to feel very exposed for not having enough positions in China. And to some extent, India will probably suffer from that. But again, let's put this within a context of more benign global equity markets.
Hi, Adrian. Morning. Adrian, what about the currency space? The dollar index, it went around 115 odd. From emerging market perspective, like we don't like that. But it's come back to around 105 odd. What's the outlook on that one?
I think the dollar peaked already, and that this expectation on interest rate differentials, which have been very much moving in favor of the dollar, the delta there has passed its best. We've had some interesting economic data out of Europe European economy is still soft, but the economic data has been surprising on the upside. There's a real potential that you will see some change in Bank of Japan monetary policy. So for 2023, you want to be short dollar and you want to be long other currencies. And I think EM is set up for a very good year in 2023 with a weakening US dollar, with a China eventually exiting this crazy zero COVID policy, and still quite a favorable dynamic when it comes to things like commodities.
Adrian, I don't know if you have any strong views on oil. You did mention China, right? China was out, in a way, out of the market, oil markets. And I was reading someone making the analogy that this is like a coiled spring in terms of demand for oil. It can come back very quickly and prices can snap back very, very fast. Is that a possibility? What's your sense?
Yes, so mobility in China has been very low. If you look at data for trucking, movements on highways, etc. So yes, China coming back into the market is going to be supportive for oil. Although I do think that the oil market's probably unlikely to move significantly beyond its current range. I would note that we've seen some very strong performance, some of the best performance on a monthly basis out of Australian commodity companies, basically on the back of China opening up. But as I look at the supply dynamics for oil, remember that you've got a consensus that the US goes into recession next year. So you've got a bit of a softening in demand from developed economies, and perhaps China coming in and bidding up a little bit of demand for oil. But I don't think energy is a place I want to be overweight in going into 2023. I think there are a lot more, much more interesting trades out there. I would highlight that we've got quite a lot of disinflation out there. Input prices year over year are down quite significantly. If you look at the cost of shipping goods, whether it's by air freight or by sea, those have come down significantly. And so I'm not so interested in things like energy plays. I'm interested in companies which might have input costs that are falling or rising less than their output costs and actually generate increased margins and positive earnings surprise against a backdrop where people are very negative on earnings.